Hey, welcome to a sneak preview of the GowerCrowd Podcast Series 4, the real estate crowdfunding show, Deal Time, where you're going to hear real estate professionals pitching their deals. I am your host, Adam Gower, and this new series actually was inspired by the incredible attention my weekly newsletter has been getting. The newsletter exclusively covers news and updates from the world of real estate crowdfunding in a super easy to follow list format. There's no fluff, just industry updates. So if you're not already subscribed to the newsletter, just go to GowerCrowd.com and subscribe there. It's totally free. And of course, you can unsubscribe at any time. Now, not only do you get the weekly updates on everything happening across the real estate crowdfunding industry, but now you'll also be getting access to actual live deals in this new podcast series. Plus, there is going to be a bunch of amazing industry information that we are putting together now. It is totally proprietary. It's going to blow your socks off. So subscribe to the newsletter at GowerCrowd.com and be among the first to hear all about it. Also, of course, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and follow what I hope are the very obvious, bright, shiny links to submitting your deal. All there at GowerCrowd.com. Now, the new series has not officially launched yet, so today's show is a special teaser, and without endorsing the deal or providing any kind of financial or investing advice of any type, of course, it is my great pleasure to introduce you to FarmTogether's Michael Van Putten, who will be talking about their latest deal, the Antelope Almond Orchard. Enjoy. Michael Van Putten of FarmTogether. I am so happy to welcome you to the inaugural episode of Series 4 of the GowerCrowd Podcast, Deal Time. Welcome. I am looking forward to hearing you pitch your deal, Antelope Almond Orchard. So we have a series of questions. I'm going to go through them one at a time. And then at the end, I have a series of knuckleballs. I call knuckleballs in America. In England, we call them wobblers. So some questions that you're maybe not prepared for. So let's just start with this. What's your name, title, and company name, even though I've already said it? Go ahead.
No worries. Yes. My name is Michael Van Putten. I am an investment associate with FarmTogether, Inc.
And tell me about the deal. What have you got? Just give me the high level. What have you got on offer today?
Absolutely. So the Tehama Almond Orchard is a 293 almond development in Tehama, California. And sorry, the deal is actually called Antelope Almond Orchard, but it's in Tehama County, California. Tehama County is located due west of Corning, in just between Redding and Sacramento, so Northern California. 26% of the property was planted in 2017. So those are fifth leaf almonds, 50% nonpareil, 25% Aldrich, 25% Monterey. And the reason I say development is the remaining 74% is going to be planted to almonds in 2022. We haven't yet determined the variety for those, but that we will finalize during DD.
All right. Now tell me the story of this deal, right? How did you find it? How did you steal it? Right? What's the story behind this deal?
Yeah. So like with most of our deals, so this one came to us, we initially saw it listed, but then the broker delisted it. It was listed past the list period. So we purchased this property off market, but we were able to secure it by our on-site visit. So we have an internal farm manager. His name is Dale Arthur. He did several decades at Prudential and is now on our team. He drove up to Northern California to view this property, along with one of our advisors, Ryan Metzler. And in meeting with the farmer, viewing the 71 acres that were already planted, we're very impressed with the quality of the trees, the quality of the development in general, irrigation system, planting, spacing, everything. So upon their recommendation, they said, hey, this looks like a great property. There's plenty of water up here. The existing trees look very healthy, and this could be a great development if you want to develop the remaining 74%. So Yeah, that's how it came to us. Just struck a deal with the owner.
Just curious. So did you strike a deal with the owner that was above or below or at what he was asking for when it was listed?
It was at what he was asking for. Yep.
And this is so this is what you would call a value add deal, is it? In farming terminology, actually multifamily terminology, I should say. This you like it because there is an opportunity to add value. Talk to me a little bit about that. What's involved?
Yeah, so we purchased the deal approximately at what you would value raw land for in this area. So it was about 13,000. Let me pull up my comps right now. So 13,700 per gross acre was what we purchased this for. And through the development, mature almond trees, a mature almond orchard at today's prices should sell for about 32,000 per gross acre. So we will be increasing the value of the property and then capturing that value with some inflation assumptions at exit. So our investors will get the benefit of appreciation of this property through the development, and then we'll also get cash yield from it.
So I'm going to ask a lot of questions because I don't really know anything at all about farmland.
All right, no worries.
It's not quite true, but almost nothing. So a mature almond orchard is worth $32,000
approximately. Yeah.
So what does it take? If I'm thinking you've got bare land here, what do you do? Do you take an almond and bury it in the sand or in the dirt, pour water on it, and then how long do you wait? Explain, how do you get from bare dirt to a mature orchard, and how do you do that quickly, which I presume is what you're doing?
Yeah, no, that's a great question. So with commercial developments, you're never planting from seeds. So we will go to a nursery. We will get year-old almonds, almond trees, and those will be on specific rootstocks to a variety that we'll decide once we do our DD. Could be independence. There are a number of different factors that determine what type of variety we use. But yeah, we'll plant essentially sticks in the ground, which are live trees, and we'll install irrigation systems, drill wells, booster pumps to overcome any slopes in the soil. And then proceed in growing the trees, apply nutrition to the trees as needed to help them grow faster. And that's pretty much it.
And how long does it take to get to maturity?
About 5 years. And then peak production is about 7 years. So we modeled the development period to be 5 years, but we typically expect to be reaching peak yields by about 7 years.
Right. So maturity at 5 years, peak yields at 7 years sounds like a peak and then it's followed by a decline. But is that actually what happens once it reaches peak? Does it maintain that level indefinitely?
Yeah, that's a great question. Almond trees have an economic life of about 25 years. So that peak level could be maintained for about 10 years. And then what we would expect to see is somewhat of a drop off every 5 years after that. Almonds can continue producing far beyond 25 years, but not at a commercially viable level. We're modeling peak yields here at probably around 24 to 2,600 pounds per acre. Almonds can continue producing 1,000 to 1,500 pounds per acre, but it's not economical to overcome your farming costs at that point. So typically it makes sense to pull out and redevelop to something else after about 25 years.
Right. Now tell me, what's in it for investors? What's in it for me?
Yeah, no, of course. What's in it for me? So if you've already bought into the thesis of agricultural investments in general, then it makes sense to own something in ag. But why almonds in particular? So almonds are the most widely consumed nut in the world. If you're planning to build out a permanent crop portfolio, and you're really thinking about what are kind of the cornerstone crops that I should own, almonds is definitely one of them. You could throw some other crops in there like pistachios, some citrus as well. But if you're starting to build out agricultural holdings in permanent crops, then you definitely want to be considering almonds. And this will by no means be our last deal, but it's the deal we have now. And as I kind of alluded to earlier, that may have been in a different section. Deals come available when they come available, right? So we can't tell you when the next almond deal will be, because we're very selective in what we select. But if you are building out your portfolio and you want to own almonds, this is a great one to do it.
Right. So what you talked about there in one word was diversification. That's one thing that's in it for me, but how much money am I going to make? Just to get right to the if you pardon it, the nuts and bolts, even though that is a little bit of a pun. Get how much am I going to make? That's what I want to know. That's what I mean.
So obviously we can't say exactly what you're going to make, but in terms of this deal, we do have expectations. So we're expecting a net IRR of about 10%. So that'd be a net IRR over 10 years. The nice thing about ag, the unique thing about ag is currently the federal government does allow you to depreciate your development expenses 100% in the year those expenses are incurred. So you have really nice depreciation benefits from developments, which investors could be able to recognize. Now, I have to obviously caveat, Farm Together does not provide tax advice, and you should not take any tax advice or any projections regarding depreciation as advice from Farm Together. So definitely speak with your tax advisors. That said, that is a big benefit from agricultural investments, is the depreciation recognition. In addition to that, we're projecting a net average cash yield of 8.6%. So that's cash in your pocket before we sell the property. And then finally, a multiple on invested capital over that 10-year hold period of about 2.2. So double your money.
So we're going to actually drill down on that. But I do have a question.
Okay.
So you talked about target net IRR of 10%.
Yes.
What is the targeted net tax adjusted projected IRR? Because I know that's slightly different. Then I have another question to follow up on that.
Absolutely. So the target net tax adjusted IRR is about 12.8%.
12.8. Is that investor level IRR or is that project level? Those two numbers, 10% and then tax adjusted 12.8%. Are those investor level or deal level?
Those are investor level. So that's net of all fees, all expenses, debt service, CapEx. That is to the investor.
Okay. And forgive me if I stump you. I'm not trying to. But do you know what the deal level IRR is? Targeted net deal level IRR.
Ooh, I don't have that on me. I could pull up the model and look at it, but I don't have an answer for you right now. All
right, get that to me later, Willie. It's one of my favorite
Absolutely.
numbers. I like to see the difference between the deal level and the investor level.
Absolutely.
Right. So talk to me about some other numbers, right? The what's in it for me numbers.
Mm-hmm.
What's the minimum investment? Let's start with that. What's the minimum investment?
15,000. So, yep, that's the smallest amount we can accept from accredited investors.
And then how do you structure the deal? Is there a preferred return? Is there a promote of some sort? Tell me about that.
So all investors own an equal pro rata share in the investment. There is no promote for any of our deals and no preferred return. So you invest into one of our special purpose entities. You own whatever percentage of the total capital we raise that you invested. And then all distributions, both the cash yield during the hold period and the sale proceeds, net sale proceeds, are distributed to you on a pro rata basis.
Interesting. Okay. And is that common for farmland, that there's no promoter? It's just a flat, straight ownership piece together with the management team, I presume?
Yeah. I honestly can't speak to whether or not that's common in agricultural investments. That's how we do it. I do think some of our competitors have higher fees, but I can't speak to that. But yeah, we just want to keep it very simple. Annual management fee, expense reimbursement fee, and that's it.
All right. So tell me about the business plan itself. You've already talked about it a little bit, but how are you going to add? What's the process of adding value, and what's the exit plan?
Yeah, I mean, so we did touch on that to a large extent. So yeah, the process is we're going to be planting almond trees next year. We'll be nurturing those trees until they begin producing. When they do start producing almonds, the 200 acres, then we'll be selling that to a wholesaler, and then we'll be getting cash payments for that sale. And then, so those cash payments, when they come in, then they'll be distributed to the investors according to their ownership percentage in the deal. At exit, the property will be at its max production. And so the trees will still have approximately 20 to 15 years of economic value left in them. And so we're hoping to capture the maximum value of the property at exit. And most likely this deal, now actually let me back up a little bit and kind of describe our sourcing and portfolio strategy. So whenever we go into a region, our aim is to actually stake a satellite property and then build out a portfolio around that. And the reason for that is at exit, we plan on selling a basket of properties to an institutional investor who would be looking for a 20, 30, $40 million acquisition. So this will likely, I mean, I can't speak to exactly what else will own the region because those come up as they come up. But we would look to sell this at its maximum value to an institutional investor.
That's interesting. So the exit is to sell it to an institutional investor together with other assets. That
most likely, can't guarantee that, but most likely that's our strategy.
What other exits are there? Like, what happens if there isn't an institutional investor, or what happens if you can't find enough critical mass in this area? What's your plan B?
So the deals, and this is highlighted in all of our PPMs, have 2 one-year extensions where we can hold the deal beyond 10 years if we're not getting a very good market price to sell it. We have gotten a lot of requests from investors on more evergreen holdings. You know, if a property is doing very well and they just want to continue getting the cash yield, can we do that? That's something that we still have to decide at a company level if we want to structure our deals that way. But for now, kind of to build up credibility and trust with our investors, we do have 10-year exits. And we have a little bit of flexibility as to whether we sell it in 10 years, 11 years, 12 years. But yeah, we would list it and hire a broker and sell it.
Right. So, okay. So let me ask you this. You're not actually farming this, are you? Are you leasing it to a farmer? Explain that whole process.
No, that's a great question. And yeah, different deals are structured in different ways. So for this almond deal, we are actually farming it. Now, FarmTogether is not on site farming it. We will hire a farm manager and pay them a per acre management fee to farm it on our behalf. But this deal is not leased. So you brought up a really good point. Some of our hazelnut deals, which we've done in the past, those have been lease deals where we'll buy it, we'll lease it to a hazelnut farmer and then charge a base rent and then some sort of crop share. And that would be the revenue to the investor. And most of our row crop deals are also structured that way, where we're leasing it. Many of the permanent crop deals, and Antelope being one of them, we own the land and we also get the net operating income from the farm. So the farm manager is earning a per acre management fee. And that's what they get, and we get the net proceeds.
Right. And so just talk to me about some basic ballpark numbers, just kind of not price per pound, but some real ballpark numbers. So for example, if I operate a multifamily building, I know that my total operational cost is going to be 35% of revenue or something along those lines. So what about with this property, when you reach maturity and this thing's ticking along and you're paying, you're producing almonds and you're selling them, what does the total operational cost look like relative to total top line revenues?
Gotcha. Let's see. So let me look at a little bit right here. Yeah, so your total operating cost is probably going to be somewhere around, and this is taking into account farm management fee, cultural cost, harvest cost, everything, probably about 60%, 60 to 66% of your top line revenue. And that's, so about between 60 and 70%.
Is the total cost of managing, in this case, managing
That's correct.
The rest.
That's correct.
Okay. And when can investors expect to get paid? When can they expect to get paid? So I invest 15,000 today. When am I going to see the first check, and what will that check look like?
Yeah, so the first check will actually be delivered in 2022. And that's because you already have a small portion of the acreage that is reaching maturity. So that 2017 planting will be mature by 2022, and it will continue to mature right ahead of the 2022 planting. So you will see a small cash yield in the first year. And that percentage will be, here, hold on, let me pull up the number. Yeah, so it would be approximately 0.5% cash yield in the first year, but that would increase over time, peaking at about 12% cash yield in the later years.
Yes, so actually preempted my next question, which was, so I noticed that basically this is a development deal, right?
Yes.
It's not it's a value add, but it's also a development deal. You're planting. You do have some income from existing crops, and you're expecting revenues to build fairly substantially as the new acreage comes online.
That's
but
correct.
I did notice something interesting here. So at year 5, so in 2016, you've got, it looks like 8% cash on cash. Let's see, payout as percentage of investment. It then spikes to almost 15% to 27, which is very nice. But then it drops. So why does it drop? What is that drop about? Then it builds up again over the next 4 years to 15, almost 16% cash on cash. So what's causing that little drop there, Michael, in between 27 and 28?
Yeah, so because so this has to deal with the way we structure our deals relative to some other forms of, let's say, private equity investment. So these platform deals, we don't do capital calls. And so what that means is we have to raise all the capital we think we could need to do this development on the front end, including potential debt service. So one of the requirements that lenders have is that we raise more capital than we actually project for debt service, just in case. So that little spike is the return of our excess debt service reserve back to investors in that last year.
Got it. That's the 894,000 of reserves, is it?
Yes. Wait. No, not the whole amount. No. So there is revenue. You are getting net operating income, but the reason it's a little bit higher relative to the year after that is it also is bolstered by that return of capital.
Right. Okay. In 2027 by
2020. Yeah, 2027.
And there is, so you're paying 4 million for the land, and you're going to invest 2 million of capex plus a new well for $250,000. So 2 questions kind of related. Number one, just explain to me what's the breakdown of that 2 million? What's that going into, right? Or how are you spending that 2 million? And why is it a separate line item for a new well? Just curious, because that sounds like capex to me as well.
Yeah, so that the 2 million that you see there in the development equity, that is for the special inputs that need to go into the young trees. So there is additional pruning that needs to happen when the trees are young, extra nutrition that needs to go into the trees. There's just extra labor on the property when you're developing a new orchard, and so that's what that is. It's separate from the well for that reason.
But you're also investing in irrigation. Like what's that 2 million? What goes into that 2 million? What's the basic line item breakdown for that?
Let's see. So let me see.
It's okay if you're not got it. I don't think it's in the pitch deck.
Yeah, it's not in the pitch deck. Let me see. Well, it's broken out over 5 years. So yeah, in the first year, you have a lot of physical capital that is being put into the property. So you mentioned irrigation systems, booster pumps, things like that. But then also the years after that, it may not be actual infrastructure, but there are special development inputs that go into the property. I don't have something itemized I can kind of break out for you right now, but I can follow up with that.
No problem at all. All right. So what are the biggest risks to this deal?
So I would say the thing that everybody's talking about right now is water, right? California, I think, just recently declared that we will be in a drought this year. So water is on everybody's minds. With regards to this property, we feel like we've hedged water risk pretty well. Sigma, so are you familiar with the Sustainable Groundwater Management Act?
Tell me all about it. No.
Okay, yeah. So the Sustainable Groundwater Management Act is a plan to make sure aquifers are in balance in California in the near future. So there are ways of rating properties on 6 key metrics to determine whether or not that they are high risk, medium risk, or low risk. So with regards to this property, even though it's a single source water property, meaning it's only getting water from wells, we still feel like it is fairly well hedged against water risk. So 75% of California's precipitation occurs north of Sacramento, which is where this property is. So from a precipitation standpoint, we're in a better region than most of the almonds that are produced in California. The 6 key features of Sigma are lowering groundwater levels, reduction of groundwater storage, seawater intrusion, degraded quality of water, land subsidence, and then surface water depletion. So with regards to this property, we really don't see any issues on these 3 levels. The only one that could be something to just pay attention to is lowering groundwater levels. But just given its location and the robustness of the aquifer, we feel like we're pretty well positioned.
Fantastic. And last question. I do love that you guys do this. You've got an upside and a downside. In my career, one of the most sophisticated companies I've worked for always did a best case, worst case, and most likely scenario. And you've done an upside and a downside. Is that something you guys do on all your deals?
Absolutely. Yeah, we want to see, hey, if things don't go quite according to plan, where do we think we could end up? So yeah, that's standard for us.
And what could be what could cause you to exceed expectations on this deal?
Yeah, so one of the reasons we only want to buy properties in Northern California is, as much as people are concerned about the drought, if the drought affects producers in the South and production is lower, then that would benefit prices, right? So you want to be the one holding almonds when other people are having trouble growing almonds. That helps your pricing. So as much as the drought could be a risk, it could also be an opportunity if we've hedged water risk correctly and we're able to produce when other people are under irrigating their fields.
Michael Van Putten, thank you, Farm Together, for telling me all about the Antelope Almond Orchard.
It's been a blast. Thank you.
That was Michael Van Putten at Farm Together pitching their latest deal, the Antelope Almond Orchard. If you want more information on this deal and on all the others in this new series, series 4 of the podcast, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It is totally free, and it's the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet. All there at GowerCrowd.com. Thank you for joining me, Michael Van Putten, and for telling us all about the Antelope Almond Orchard deal over there at Farm Together. That is it for today. Thank you for listening. This is Adam Gower, wishing you well and signing off.